retracements and reversals. Now, retracements and reversals are a very, 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 very important concept when we're trading, whether we're trading CFDs, whether we're trading Forex, no matter what, and it doesn't matter what we're trading. To look at a price and to look at a chart, we have to be able to see what price is telling us. And retracements and reversals, seeing them and understanding them, being able to tell the difference can help you make a lot more money or stop losing money. Retracements are a natural movement of price. My whole scenario, my whole story about price and trading is price is completely random. Nobody can really predict price. It's made up of millions of human beings making millions of decisions all over the place. Plus you have institutions, you have banks, you have everything else involved in there. And so therefore price is completely random. Now, there are certain times when price becomes non-random. Those times are when price is trending. Price is either moving up or moving down. Okay? And to be honest with you, this doesn't happen so often. We think it happens a lot, but most of the time price moves in a sideways mess, moving up a little, falling down a little bit, moving back up, and a total congestion. When price starts moving in a specific direction, uptrend or downtrend, it takes a lot of energy to start one and to maintain one. So in other words, price is down here, and we'll look at a live chart in a minute, and buyers start entering the market. Okay. They're not all talking to each other. There's not one great big community, but this buyer over here, that buyer over there, they see something in the charts and they start buying. Well, imagine this like a hamster. Remember when you kids, you had a little hamster in a cage and he used to run around this wheel? Well, at this point, that hamster stepping on into that wheel. And you see those little feet and you see that great big wheel and you're saying, wow, that's going to take an awful lot of work for him to start turning it around. Well, he starts turning that little wheel and it turns once and it turns twice. And before you know it, that wheel is really moving fast. That's what happens when trends start happening, is people start jumping in the market and turning that wheel. And that wheel starts pushing up price. And that's a lot of energy. At some given point, that hamster needs to take a breath. Or what happens in the market here is that these buyers, whether they're retail buyers, professional buyers, institutional buyers, most buyers enter the market with a certain objective. They're not in the market to let the market run. Especially people buying big positions. Okay. You know, a professional trader, a bank trader, they're very happy if they buy the euro and invest a couple $1 million in the euro, and the euro goes up 10 pips. They're happy. They've made their profit. They've made their money because they set it up. And when they set it up, they've already set a sell point. They're not in there to gamble whether the euro is going to keep going up because they can always re-enter the market. They're looking at what point they'll exit. So people have started putting sell orders. The buyers who came in here and here have put their sell orders at this hypothetical price. Now, there's reasons they picked that price. Whether it's a previous price point that they've seen with support and resistance, whether they use Fibonacci levels, whether they just know that this is going to become a point where the price is probably going to drop or take an ease. So what happened is they put their sell orders in. As price moves up there, it starts kicking off those sell orders. When those sell orders start getting filled, the market eases. That ease is known as a retracement. That is a healthy part of a trend, of an upward movement or downward movement. We want this healthy move, because what happened was at this price, the buyers The buyers that we're watching now, like you and me, we don't ever see the beginning of something. We're looking at it now and we're saying, it's pushed up too high. We're not going to enter the market now. As it retraces down at some given point, all those sell orders are filled, so that ease in the market's over. And some of us sitting on the sidelines start to say, oh, that's a good point. That's a good price again. I'm going to jump in the market and buy. And they start that wheel turning again. And that price keeps going up and up and up and up until it does the same thing. This is the healthy part of an uptrend. So we have to be, because if this trend was going to reverse and not come back up, it becomes a reversal. And we sure don't want to be in that market and start losing our money because we didn't get out at the right time. So we have to be able to look at our charts and tell the difference between a retracement and a potential reversal. Because the other thing is, we don't want to start jumping out of the market too early. If we entered, say here, we saw this momentum, we're a retail trader, we would see it maybe about here, maybe we got in the market here. As it starts retracing, we don't want to jump out of the market and all we made was those couple cents profit, because we know it's going to ride back up. If it's a retracement, we know it's going to continue back up. So we don't want to jump out too early. We don't want to get frustrated. We don't want to get scared. So let's start off with some general definitions of what's the differences between a retracement and a reversal. So a retracement is a momentary reversal that occurs during a longer trend. Usually reversal retracements show a continuation of an opposing trend within the targeted asset's price action. So as you can see, there are a couple of retracements that take place and occur throughout a prolonged price movement. Now, I call these pushes and eases, peaks and valleys. Prices are climbing, pushes up, it makes a peak, it eases back down, makes a peak, eases back down, makes a peak, eases back down. Now, if we're using trend lines, okay, trend lines have a very specific rule because price can never have broken that trend line. But in an overall trend, we don't have such a thing. Price trends are a series of movements. Now, price, while it's moving up, should be making higher highs and higher lows. Higher high, pushing to higher high, and then easing back down to a lower low. Like this low here should never be as low as this low here. This low, this high here should always be higher than this high here. So we're constantly making new peaks and new valleys. When this low gets lower than the previous low, we need to worry, or we need not to be in the market. Because that's when we're seeing that a retracement is really becoming a reversal. So reversals are temporary changes in an asset's trend that occur over a short period of time. Oftentimes reversals can last minutes, hours, or days. It just depends on the time frame we're utilizing. Reversals are oftentimes dramatic and do not represent a long continuation of an opposing trend during the asset's price action, like seen with retracements. A reversal doesn't mean necessarily that the uptrend has kind of ended. It can fall all the way back down because it can last for minutes, days, or hours, and it could then, when it's finished that little reversal action, move back in. But it's a break in the current trend. It means you shouldn't be in the market. Now, everybody tries to define the difference between not define it, but spot the difference between a retracement and reversal. Lots of people have tried to put terms or definitions or reasons, but the fact is a good trader will feel the difference. He's not going to look for a set of rules. So here, some people look at volume. Now, sure, when it's a retracement, we will see profit taken by retail traders in small blocks. If we see a huge shift in volume, that means institutional selling because you're selling large blocks. But that doesn't necessarily mean it's going to reverse. It means that they're getting out. They could re-enter the market. Like I told you, these institutional selling investors already, we reached their profit target. They're happy. Money flow. Okay. Yes. If we could see it that fast and see how many contracts are being exchanged at that precise second. Now, chart patterns. We can sometimes, if you're really good with your candlesticks or reading your price, you can see this through a chart pattern. Bullish and bearish engulfing help. Indecision candles combined with support and resistance levels will give you some interest. Short interest changes, we don't even see it in our type of trading. Time frames we don't see. Fundamentals. Change in fundamentals doesn't really tell us whether we have a retracement reversal. Recent activity. If we see a huge push up in momentum, and say we were in the second or third wave of a trend and it moved all way up, okay, we might be in for a small reversal because everybody took their money and ran. But the fact is, when price reverses, or you're not sure whether to reverse or retrace, you only have three choices. You can only make one of three decisions. But we don't want to make the wrong decision. So we can hold throughout the sell-off, which could result in large losses if the retracement turns out to be a much larger trend reversal. We could sell and then rebuy if the price recovers. Well, that's always a chance. Okay. Sometimes it's the safest chance. But the fact is, we're never going to sell at the top, and we're never going to be able to buy back at the bottom. So we're going to end up losing a lot of profit potential and double our costs by doing this. And we may even move, if that retracement is a shallow retracement and then starts moving with a great deal of momentum, by the time we got back in the market, we could have missed a lot of opportunity. And then the third thing is, and which is what I firmly believe in, is if I'm confused and I'm not sure, I just get out of the market. Okay. I don't sit there and slap myself later and say I missed an opportunity. If price starts doing things that I don't understand, I'm gone. But by properly identifying the movement as either a retracement or reversal, you can reduce costs, limit loss, and preserve gains. Because remember, traders have an expression for trying to pick the tops or bottoms of the market, and it's called trying to catch a falling knife. Okay, and there's no way to stop you. There's no way. There is no formula out there to really be able to pick the tops or pick the bottoms. And I don't want to pick the top. I want to get in the market when I see that the market's got the momentum, and I want to get out the minute I see that market momentum wane. I don't care if I made a few less pips. As long as I made money, I'm a happy camper. So just keep in mind, a healthy trend is a healthy trend. The more defined the trend is, price can move. Actually, let's bring up some live charts. Let me pop up. So I got them all set up already for us. But these are live charts you're looking at. These are not graphics I made up for you. So here we can see as the New Zealand dollar, US dollar ease back down, look at this. Higher high, lower low, higher high, lower low. Stay within a channel, and we can define it. What's happened is price has become non-random. When price starts moving in a non-random fashion, we can make good, solid decisions. Okay, again, price moving up. Okay, now you can see that this trend here is much different than this trend here. This trend is a much more qualified, clean price trend. This trend is kind of dirty. We can define it by a channel. We can see lots of things. It's holding support and resistance, but it's making higher highs, lower lows, but it's really a mess. Now here we have a beautiful downtrend. And we can see, hold on, let me get my marker on here. We can see the push, the ease, the push, the ease, the push, the ease, the push, and then sideways mess. Hold on 1 second here. There we go. Now, this is the live euro US dollar chart. It's my standard teaching chart. But look at this well-defined trend. And this trend would have made it very easy to make smart trading decisions. And this really should be the only time that you're trading. See, if you're trading in that, you're trading in a mess and you're guessing. Here, you have a well-defined trend. You have non-random movement, and you can make decisions. Look at what happened at the support and resistance levels on the chart. Look at what happened at every type of ease and every type of movement we had. Hold on 1 second, let me get. And we could have made intelligent trading decisions. Now, my rule of thumb is I only want to trade when there's high potential profit and no randomness in the markets. So what? Today I only got to get 1 trade in. Maybe tomorrow I got no trades in. Next day maybe I got 2 trades in. But guess what? They were well-made trades that were successful. We're never going to be right 100% of the time. But when we can lower that percent, because the other thing is when we have non-random movement and we have a well-developed trend, setting our stop loss and our take profit points become easier. If you thought the euro was going to go down, the euro US dollar was going to decline, and you were looking at this market, where would you put your take profit? Where would you figure your entry level? Where would you enter the market? Where would you put your stop loss? Where would you put your take profit? You know, what could you have done to trade that? Too many traders would have seen this push here, and they say, it's continuing its upward movement. I'm going to buy into the market. Well, they were completely wrong because they still have garbage here. And what was this? It was a temporary shove and ease. I don't know what happened there. It all took place in, a couple hours. So understanding that retracements are healthy and important parts of trends, that you don't panic. Now, retrace and some tools that help you. Support and resistance levels will help you. Fibonacci levels will help you. Okay, to see whether you have a real retracement or a reversal. A fib level, when you're looking at 38, 68, 50, and price is easing back down, making that retracement, and it goes through the 38 and goes down to 50. Well, a lot of us said if it retraces below that 50% rule, we're out of the markets anyway. Okay. But it quite often goes down to 68 and then turns around and continues on its merry way because it's still staying within its trend. But you can see that a retracement of an asset was unable to push to higher highs. And that's important. When that trend is moving up and you get the rejection and can't push to the higher high, it's not telling you the trend is going to end at the moment. It's telling you the trend is in danger. So reversals are defined as a change in the overall trend of price. When an uptrend switches to a downtrend and a reversal occurs. Now, that doesn't mean that we're going to see it here. What we got is that was a reverse. That point right here told us that this trend was in trouble. We couldn't continue pushing to higher highs, and we came down and we started getting lower lows. But we wouldn't have even noticed this. We might have been saying, "Oh, let's keep an eye on it," but we wouldn't have even known that it was reversal till we were farther down this way. And so by the time we realize we actually have a reversal, we could be in bad shape. Because remember, there's only 3 choices we have. You could hold on to your position and hope that you're wrong. You could close your position and re-enter when the price reverses, or you could close permanently. Now, because reversals can happen at any time, choosing the best option isn't always easy. So you need to be prepared. Now, my firm belief is setting up a trade, and I personally love trailing stop losses. And we should always, when we set up our trade, whether you're using a set stop loss or a trailing stop loss, is to have exit methods. A lot of times when I'm faced with, is it a retracement reversal, I might close out half of my position and then move my stop loss a lot closer. And then if it starts moving back in invasion, I haven't sold out of everything. I've locked in my profit because I've already set my stop loss, moved my stop loss up. I sold half of my position and booked my profits already. And if it reverses and runs up a little farther, I'll keep moving my stop loss up closer and closer until I'm stopped out. But I only get stopped out in profits. Now, there are some tools that'll help you. Like I mentioned, Fibonacci retracements are a great tool to understand and help you look and see whether you're seeing a reversal or retracement. Pivot points, support and resistance levels. I never trade. If you notice in all the charts you were looking at, you saw support and resistance levels drawn on there. My charts always have my support and resistance. They tell me more than anything else I need to know. Trend line support and resistance levels. Chart patterns. I am a chart pattern trader. I use support and resistance and chart patterns. That's basically what I trade from. I don't use indicators. Okay. But you can use a momentum indicator. Will help you see that when the trend is in trouble. Because as you know, when you shoot a rocket into the sky, firework into the sky, it's going to have great momentum. As that momentum starts to wane, we can see that in our oscillator before the shift in momentum. But whenever we lose that momentum, then we also have oscillators to show you speed, because a shift in speed, even though the asset is moving up, an asset could be moving, hold on, let me get my marker on here. An asset could be moving, push and ease, push and ease, push and ease, and it's got a certain speed it's moving at. It can continue in those pushes and eases, but it can start losing speed, not losing momentum, but losing speed. That's a warning sign also. So there are many techniques that you can employ to see that. Like I said, Fibonacci levels, great tool. Prices retracing, eases down, 50% level, bounces back up 23.6. Okay. And it hasn't broken that 50% level, and it's recovered from that retracement. Pivot points and support and resistance levels will help you all along the way. Trend lines are trend channels. Chart patterns. I only trade from triangles. Okay. For us, things like head and shoulders, they take way too long to develop. They're way below our type. They're too slow for our type of trading. But triangles will help you see a lot that's going on if you have a triangle. But keep in mind, technical analysis is a study of historic prices. Technical analysis tends to be, in most cases, lagging. Most indicators are lagging because the only things you can use for indicators, every indicator either uses the open, the high, the low, the close, or volume. All of those had to take effect and already take place. Okay. And they take those numbers, whatever they are, however they want to crunch them, and then add that to some type of mathematical or statistical formula. But most of them are lagging indicators. So because they're telling you what the market has done, there's very few really predictive indicators. Because if we knew what an indicator that would really predict the future and tell us what's going to happen, well, we'd all be getting rich out there. Now, different strategies have varying degrees of success depending upon where the market is in a bigger time frame. But remember, we want to see that stair-step motion, and will help us make those decisions. So, of course, as with any strategy, there's no singular perfect strategy that will always guarantee profit. Naturally, this means you cannot rely on a strategy alone for profits because it may take time between each potential opportunity. So as a trader, you need to be able to differentiate between retracements and reversals. Without this knowledge, you risk many things such as exiting too soon, missing opportunities, holding on to losing positions, or losing money and wasting money on commissions or spreads. By combining technical analysis with some basic identification measures, you are more than aware of the risks and you can put your trading capital to better use. So remember, if you have any questions, please feel free to write them in the box and somebody will answer them for you. And if you have questions that were not about tonight's class, please go on to www.alvexo and use the live chat or the support button and fill out the form. And we will be glad to give you all the answers, to give you a call, to send you an email, whatever you would prefer, or chat with us live online now at the live chat. So thank you very much for joining us. Good luck with your trading, and we'll talk to you again real soon. Good night now.